Hello. I want to talk briefly about accounting for loans, as this is something that's important. A lot of business owners have loans, either for their business or for vehicles. So it's important to get the accounting correct, and it's just a tiny bit tricky. But if I show you how to do it, it'll be really easy for you to account for it. So there are a few accounts that you need when accounting for a loan, and we'll go over to the chart of accounts here. The first one you want to have is to house the initial loan payment. So when the money comes into your bank account, you need to put it in an account. So we would want to create a loan payable account. And that depends on whether it's short-term or long-term. If it's short-term, it's a current liability. If it's long-term, it's a long-term liability. So long-term would be paid over the period longer than a year. Short-term would be within the year. So let's just say we're setting up a short-term loan here, and we can choose loan payable. And then I just like to have a little information about who the loan is from. You could have the name of your lender or whatever helps you identify this loan. You would want to enter that here, or maybe you might say it's a PPP loan, or maybe you got a loan from Intuit. So we'll just create that here. And then when you see your initial deposit come in for that loan, you would categorize it to that loan payable account that we just created. So that's the first step. Then the next step is just accounting for the payments. So you're going to be making payments against the loan. And let's take an example here. So let's say this $800 was a loan payment. So really all we need to do is split out the payment between, with almost every loan, unless you have an interest-free loan, you have a payment of principal and you have a payment of interest rolled up within that main payment. So we just have to split that out, and we can use the split transaction feature. So let's just go to split. What the place you're going to get this information from would be on your statement typically. Sometimes they'll give you an amortization schedule, which would also show that information, but usually you'll get some sort of statement every time you make a payment, and it'll show that total payment number, and then it'll have a breakout between interest and principal. So that's all we're looking for. We're just looking for that data. So we can start here, by having the payee. That can be your lender. And then the first category is just interest expense. And you can create an interest expense account. You could even call it something more specific if you want to have just interest tracked for that loan. So you could have interest expense dash into it. So you have the first line is interest expense. We can just create that really quickly. So that's an expense account. And that is interest paid. And I'm just going to call it interest expense. Fine. And then the other account is your loan payable account that you originally set up. So really easy. We can just grab that loan payable into it. That's your payment of principal. So again, you're going to look at the breakout. So let's say $200, is a payment, is the interest portion. And then $600 is the payment of principal. And then you have the total amount of $800. So you want to make sure there's no difference here. And if that's the case, if everything looks good, then you would just hit apply and accept. So now you've recorded that total payment between interest expense and payment of principal. The payment of principal goes against that original loan amount. So this will help you categorize your initial loan deposit and your loan payments.